From the morning reading, the S&P 500 had a bad Friday, down for the week. The equity markets around the globe had a bad Friday. Asian indices were modestly lower, but European indices sold off sharply. The Euro Stoxx 50 plunged 2.6%. In the U.S., the Dow closed down about 2/3%, the NASDAQ down at about 1.3%. The preferred benchmark S&P 500 split the difference with a 0.92% loss, which was well off its 1.21% intraday low early in the final hour of trading. Friday's sell-off caused the index to snap its 3-week rally with a 0.15% weekly close, and that was down 0.15 weekly, although last week's close was a gain only if calculated to 3 decimal places. The 10-year note closed at 1.44%, down 4 basis points from the previous close and a single basis point off the 2016 closing low on February the 11th. The yield is a whooping 61 basis points below its 2016 closing high on January the 5th. The pullback accelerated on Friday. Potential bull flag is forming. Dollar stronger, oil weaker. Brexit concerns rise overnight in Europe. Just one of 9 sectors moved higher on Friday. XLP, XLU, and XLB were the strongest sectors, while XLE was the weakest sector for the 3rd straight day. Oil futures fell $1.58 to close at 48.88 after closing above 50 for 3 straight days. The plunge in global bond yields sparks a flight to safety. Record low foreign yields pull the 10-year Treasury yield to a 3-year low. Brexit fears hit pound and Europe. Overbought oil market due for a pullback. The S&P 500 and falling bond yields boost dividend iShares. The overbought S&P 500 also due for the pullback. The daily chart on the S&P 500 also suggests vulnerability to more short-term selling. The chart shows the SPX trading above its April high at 2111 at midweek, but it wasn't able to hold that modest upside breakout. The SPX lost nearly 1% on Friday, the end of the week back below 2100. And it did so in rising volume. More importantly, its 14-day RSI line failed to reach its April high near 70, which formed a negative divergence in the RSI. Daily MACDs are also well below their April high, all of which suggests the SPX may be due for some more profit taking. A pullback near its May low in the 200-day average wouldn't be surprising and wouldn't disturb the uptrend that started in February. The S&P 500 has had nearly a 90% correlation with the rising price of oil since the February bottom. A pullback in that commodity, which appears likely, could also weaken the S&P 500 over the short run. So could a further bounce in the US dollar. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:06 a.m. Mountain Time, and I'm recording this in preparation for the market day of June the 13th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, quite a bit there with the morning reading, various authors weighing in over the weekend. A lot happening at this time. We've had what we've been talking about for quite some time, many different markets up against this area of resistance, and whether it's Brexit or oil, whatever the cause, heck, the 10-year yields certainly are also doing some interesting things. There's many different reasons for this kind of short-term pullback to be happening right now. It might not be over. Let's go ahead and take a look at the overnight activity in the U.S. on our 4 broad market indices. Those futures are all down, though modestly. At the time of this cut, the S&P was down almost 6 points, or about 0.3%. Russell futures are down just a little bit less, and NASDAQ was down about 0.4%, and Dow futures were down about 0.33%. Crude oil down much larger, about 1%. The euro up just above scratch, bonds up just above scratch, and gold up about 0.9%. In China, some big activity going on overseas. China down over 3%, Hong Kong down about 2.5%, Japan down about 3.5%, Germany down a bit over 1%, and then United Kingdom down about 0.2%. So Asia getting kind of hit hard. In terms of macroeconomic reports for today in the United States, there is nothing. Looking forward to tomorrow, we have core retail sales and import prices, and that would be about it. So fairly light beginning to this week. In terms of current volatility conditions, we have been decreasing in the 5-day versus the 10-day, kind of the big trend. Short-term VIX, though, well up over the 10 handle that we had seen there for a brief period. It's up around a 15.83. Skew also up, well up into the warning area at a 133. So about a 10% probability of a 2 standard deviation move in the next 30 trading sessions. In terms of the IV percentiles, these have also been coming up, though they're still very, very low, all below 25 percentile. S&P a 20, the Russell 22, the NASDAQ a 15, and the Dow a 13. We did have standard deviation moves put in by all 4 of the indices on Friday. They are all down at least a single standard deviation move, and that was the first move in the S&P in 10 trading sessions that was greater than a 1 standard deviation move. So we were due for some increasing volatility, and we were also probably quite due to have some negative action. So nothing terribly surprising there. Let's go ahead and bounce over to the charts, and let's go to the S&P futures. And you see this area of resistance we've been talking about for quite some time. And let's go ahead and extend that out. And indeed, we came up, we tickled, and then failed fairly dramatically. We've come down some fib clusters. We could very easily come down a bit more, but there's a pretty significant amount of support here. So there's really nothing yet that is challenging the short-term bullish market posture. And you'll see as we go to the daily report that there's just, this is just a pullback within a bull market as far as most the major indicators are concerned at this point, until proven otherwise. And there are significant lines of support, whether you're looking at fib clusters, major moving averages. One of the morning authors mentioned the 200-day moving average. You've got the cloud down here. There's a lot of support down here. And at this point, not expecting us to get significantly down on this pullback. In terms of the Dow, this has been moving very closely with the S&P of late, though in relative terms a bit weaker. But you see the action coming back, rolling over, from near the former swing highs, as opposed to penetrating and going a little higher like the S&P. But it's down into the cloud at this point. But again, just kind of coming back into the first levels of support and really not violating anything there as of yet. In terms of Russell futures, Russell had been on a short-term pattern stronger than the S&P, and it's also pulled back with Friday's action. But again, just a minor pullback at this point with plenty of support below. Nothing really to get too excited about at this time. And then NASDAQ. NASDAQ's been relatively the weakest, and it's pulled back, again, very similar looking pattern, both in size and scope and so forth. Nothing to get terribly excited about. Probably the most interesting story of late has been the bonds. And those yields have been, especially on the 10-year yield, have just been absolutely going crazy, and you see bonds is in a clear, clean breakout. And if anything, when you look at what's happening with the bond market and the kind of the flight to U.S. safety, and I say not just safety, but the U.S. safety, because if you look at the differentials now between the yields in Europe and in the United States, there's a lot of money, it would seem, that's moving into U.S. bonds. And here on ZB, you can see that this is a clean, clear breakout. We have clearly surpassed all the recent swing highs. And on a closing basis, I believe this one was right at, if I remember, I looked at this over the weekend, but it was right at the all-time closing high. Now, obviously, you got a wick activity and this kind of big capitulation move that we had back here. But this is a very clear run towards the all-time highs in the long bond. Let's go ahead and take a look at TLT. You can see this. Yes, indeed. On TLT, there was a closing high because your close would have been right here. So we had a new high, closing high, 52-week high on TLT. And then you can see its all-time high also was tickled. So on the regular ETF. Gold, if you're talking about a run for safety, most of the time you also think about gold. And certainly gold has had this kind of huge move coming from not too many trading sessions ago, the 1200 handle, all the way to almost the 1300 handle in just, say, 1, 2, 3, 4, 5, 6, 7, 8, 9, less than 2 weeks, almost a 100-point move in gold. Just when you thought the gold was just totally breaking down, in it comes, and they just rip it all the way back practically to the former swing highs, the 52-week high, in less than 2 trading weeks, with nary a pullback. I mean, you got one red candle in there, and that's frankly, looks like a hammer pattern for, though in an odd place, not really a reversal pattern. But you've got one time where you had a bit of down action, and then intraday, it took it back up and almost regained the high, and that in 2 weeks is basically about it in terms of negative action. Just about 2 weeks. Let's take a look at the VIX. What is the VIX telling us? The VIX is popped higher, and we are well up over the prior activity. And you look at this, we're up over the 18 handle. So, that says that's today's action. So Friday's close was still in the 17 handle. I guess this is already charting today's action. We are about 6:15 a.m. Mountain Time, so the market will open in a little over an hour. But the VIX seems to be quoting right now up over 18. So we'll watch that for today. That would be the first time it has done that in several months, going back into March, since we were up over the 18 handle. Okay, that's probably enough on the charts for today. Let's go ahead and go to the daily report, and a couple subtle changes here. But probably the big story here is that while we see some short-term pullback activity, which was very overdue, these indicators were very overbought, and these trends were right up against significant areas of resistance in almost all cases. But yet, in the big picture, all the mechanical signals are still very, very bullish. Intermediate term phase opinions of phase 2, a trend reversal, though if action continues to deteriorate, we may see a change in that. At this point, still phase 2. In terms of the 3 market timing signals, IBD has confirmed uptrend, no change there. GMI index, a perfect 6 out of 6, still has a buy signal in place since 525. The more sensitive GMI2, still a 6 out of 8, so that's quite robust. And then from Stock Chart's decision point scoreboard, the short and intermediate term across all the different indices is still all universally bullish. Not a single signal has turned bearish as of yet. Now, we still have that long term that's got mixed signals, and that's been the one fly in the ointment in terms of all these market timing signals being in a perfect stack. Position sizing opinion is still 100% for both models, both the portfolio investor as well as the volatility metric. And then in terms of our intermediate term market postures, they're still all very, very uniformly. In fact, the severely strong bull category, they're all up over 80. The Dow was the last one, actually with Friday. This is, remember, intermediate term, not short term. Intermediate term still, actually went up on Friday to an 82.2. Then you look at the overall hedge warning status. We've been at a level 1 for a number of sessions, and we remained at level 1 because we had been seeing some signs from the various indicators that we follow that told us that there was still elevated risk in the market. So this is not happy-go-lucky, healthy bull market from all signs. There are some signs here of concern, and we have reflected that in the hedge warning status. So we're not surprised at this pullback, and yet at this point we're not going to be overly cautious or defensive until proven, more thoroughly. Option income strategies, this VIX is still in the acceptable window, though as we were just looking at the chart, we were popping up over 18. If we go up over 18, then the VIX would not be in the acceptable window to initiate new positions for novice traders. Now, more aggressive traders may welcome the pop in volatility and the increased premiums, but you also, along with that, take on the responsibility for handling larger than expected delta and vega moves. So just be aware that the risk is increasing here, and this opinion here may be right on the threshold of changing to a do not initiate for the novices. Cover call strategies. I thought this might change over the weekend, but it didn't. It's still cautiously bullish, considering using a 3-to-2 ratio of in the money, in out of the money strikes, also a 3-to-2 ratio on low beta, high beta. You might want to consider legging in to some of these strategies by selling out of the money puts, and certainly consider the size and scale that you are going to be using. Might consider reduced position size as you watch this situation develop. Remember, we're just expecting this to be something of a bull flag until proven otherwise. In terms of put selling, same kind of conditions. We're still level 1, so consider that position size. Consider if you're using a more aggressive setup that you might go with reduced position size, and always keep that positions in the scale that you are willing to own. You see from the various individual warnings, we had a number of things firing here at the end of the week. Market in decline, sharp increase warning, both fired. The volatility ratio fired again. We're still in that VIX daily futures daily squeeze, but that's probably getting ready to fire if we continue with this action. The distribution day count on the S&P actually went up a notch with Friday's action, so that's now at a 6. The VIX phase has been increasing. The skew's up over a 130 now. Also, you had the 10-day expected move in the SPX now up over 40. So there's quite a bit of red here. We feel quite justified in having left that hedge warning status at a 1 through recent action. Another reason that we had that is that you have this key intermarket risk aversion indicators. All 5 of them had turned to risk off earlier last week. So we were not surprised at all with some negative action coming. From a sentiment standpoint, with the move that scrubbed off, much of the excessive sentiment from the short term, this is now back to more normal levels, though bonds are at a extreme sentiment level. China, in terms of the ETFs, is at an extreme. The fear and greed index, again, much of this is scrubbed off. This has come down to a 61. You see just the previous close was a 79. A week ago, 77. We were playing up here in these upper quartile, and it didn't take long playing in that upper quartile before we had a reversal and bringing this down. In terms of sector specific, a lot of change here. This was a sea of green coming into the Friday session, and with the Friday action, we have wiped out a lot of that positive aspect. And you see the short to intermediate term, a lot of neutral, a fair amount of down, only two that are holding up in all three time frames as green. And note consumer staples and utilities. While when the markets are hot, these don't go flying the same way. They do hold their value better when the markets pull back. And as you'll see down here, look at consumer staples. Look at the performance through the year to date and the 1 year, especially the 1 year. So we've had a lot of chop in the last year. And while, for example, you've had energy has done really, really well in the short term. You take the 3 month, it's up 11%. But look at the 1 year, it's still down 11%. Whereas utilities is up 19% in the 1 year time frame and is the #1 performer. Look at also the year to date, #1 performer is utilities. In the 3 month, more of a mixed bag. It's not going to be quite the hero. You had materials and energy that really had taken off in the short term, but what happened when the market got weak? Energy gave up 2% in a day, and materials gave up, about 2/3%. Whereas utilities was down, but not by much, and consumer staples actually eked out a small positive gain. So when you're concerned about where your portfolio is, just remember the value of having telecom, consumer staples, and utilities. These are the more conservative and more defensive areas, especially as yields start going crazy. These generally have very good dividends, and people run to these places like Verizon, like the the Cokes, the Pepsis, the other staples, and so forth. Con Ed and other utilities will generally do relatively better. They'll hold their value better in many ways. So that certainly seems to be reflected in the current market conditions. If you look at the relative rotation graph, you see not much up here in this upper right quadrant. We like to see activity with action moving this direction. And if anything, almost all these are fleeing the upper right quadrant and weakening. You see even XLU, IYR, that's the REITs, are falling down, though we should note these two that are improving, FDN and KRE. FDN, of course, is the Internet Index. We've actually taken a position in the room with that ETF. And then KRE, the regional banking. So those two are the ones that seem to be kind of in a relative sense improving of late. So that should be enough for today. We've gone over 20 minutes, which is not untypical on a Monday session with so much good information that comes in from various authors and other analysts over the weekend. Let's go ahead and roll through the closing sequence here. If you see something of interest, just hit the pause button. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And do note at the bottom here the hyperlink that takes you to the full set of disclosures. We'll see you back here for tomorrow's market preview from Falcon Global. In the meantime, good trading.